Hey folks, welcome back to the channel. Liquid here. In December, I was able to make over $1,500 trading options, which was a record month, and I was able to do it primarily through selling put options. This is when somebody pays me to buy their stock if it falls below a certain price. And based on my strategy, 9 times out of 10, the stock does not fall enough to trigger the assignment, so the contract expires worthless. But of course, every once in a while, it does happen, and sometimes I receive questions from you guys about this topic. Like, what can you do when an option expires in the money and the stocks are assigned? So in today's video, I'm going to demonstrate one simple strategy that you can use to move forward when a put option is exercised against you. This trade is called a sell strangle, or also called a short strangle, where you earn a premium right away, so that's always good. And the worst case scenarios are A, you sell your assigned stocks for a profit, which, isn't all that bad, or B, you buy more shares but at a lower price than what you initially paid before. And of course, this lowers your cost basis, which also isn't really that bad if you're a long-term investor. So here's an example of a put option that I sold in November and I got assigned in December. Last month in November, I found this company, Stella-Jones, which is in the lumber industry, and they make utility poles and they have railway ties. And what I realized was they're kind of undervalued. The price to earnings ratio, definitely lower than historical average. And analysts are giving it a pretty high price target over the next 12 months. And at the time that I was looking at this stock, it was trading at about $42. So what I decided to do in November was sell a put option on Stella-Jones with a strike price of 40 expiring on December 17th. So what that meant was I made $50 right away. That's the premium I earned. And if Stella-Jones doesn't go anywhere, then I would just make $50 and I would probably sell another put option on it. However, on expiration date, it fell below $40. So what that meant was I had to buy 200 shares because I sold 2 put options at $40 per share or $8,000 and I picked up 200 shares. So in Interactive Brokers here, I have Stella-Jones selected as my stock. You can see the position I have is 200 shares because I was assigned that in just last week. So I've talked about how to sell a put option. That's how I got this 200 shares in the first place. And I've talked about cover calls. A short strangle is pretty much what happens when you combine a put option and a call option. So both of those things at the same time. And the advantage of that is you get 2 premiums. I'm going to bring up the options chain. That's what this looks like for Stella-Jones. I'm going to look at the February 18th expiration, which is about 2 months away. And currently the stock is trading at about $40, 39.6. So I'll probably sell a put option here at 38 because if I'm okay buying the stock at 40, then I would be even happier buying it at $38 because it's cheaper. So if I was just selling a put option, I would click on this button here and it would take me to the order entry and I would sell a put option. This is what I did before and that's how I got my 200 shares. But instead of just selling a put option, I'm also going to sell a call option at the same time. So to do that, I have to turn on Strategy Builder here, turn that to on, and I can choose either $37 or $38 as the strike price. You can see the delta minus 0.2, so there's a 20% chance it will expire in the money if I choose a $37 strike price, 29% if I go with 38. So maybe I'll go with 38 because the premium is a little bit higher and it's worth taking that little bit extra risk. And if I buy it at 38, I think that's a really good deal for this company. So with Strategy Builder turned on, I'm going to click on Sell, and this is going to add a sell leg, leg 1 here. And I'm going to go down to, but maybe I'll go a little bit further out. You can see the color change from this kind of darker blue to a lighter blue. And just means it's one standard deviation higher. This is 1.1 and this is 0.8. So at 1.1 standard deviation, not likely to happen. I'm going to go with this one. So same thing, I want to select the sell leg because I'm selling a call option, right? Because I want to earn the premium on both of these options. So I'll click on that. So now I have 2 legs, both expiring on the same day. So this means I won't have like one option expire and then another day, another option expire. and then because that'll just add unnecessary risk. You can see IB here tells me I am doing a short strangle, which is the strategy that I'm using right now. The bid and the ask price of each of these separate options that I'm selling and what they add to together, which is also down here. So for the quantity, I'm going to choose 2 because I have 200 shares, so I can afford to sell a covered call for 200 shares. And if I buy another 200 shares, if it goes below $38, for example, if my put option expires in the money, that's fine. I'll just have 400 shares and I would have lowered my cost basis because I bought my first 200 at $40. I'll buy another 200 at 38. So the tricky part is really just setting the price. So I will choose something kind of higher, maybe around, I'll choose like 95 to start with on the high side. And between now and now would be December 22nd and February 18th, so about 2 months away. If Stella-Jones maintains its trading range of $38 to $43, then nothing happens. Both of these options expire worthless. So I'll bring up Yahoo Finance over here. You can see it's currently trading at just under $40. It's probably not going to fall lower than that because we do see it bounce up from, this is about 38 in 2018. And then in 2019 and 2020, it kind of stayed around that $38 range. So there was a large dip during March of 2020, as most stocks did at the time, but then it just bounced back right away. And because the company is making more money every year, you can see the revenue here, it's like growing, 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 and the earnings per share is also growing. Even the dividends, that's another good indicator, is you look at the dividends year over year and just make sure it's not decreasing. That's a pretty good sign that the company is strong and upper management has confidence that they don't have to cut back on distributions. So that's why I don't think it will fall below what it did before because it's making more money than it ever has before. So it should continue to be a really good stock. If we have a black swan event, it might fall back down to 20 something. That's not likely, but even if it does, you can see it'll recover. So I'm pretty confident with a 38 put and a 43 call. That's pretty good because I don't want it to be too high. Otherwise, there's no point writing a call option because the premiums would be so low. But I don't want to go like 41 or $42 because it could easily hit that. You can see it's coming down, but if it bounces back up, it could easily hit that in February of next year. So I think 43 is a pretty good balance there. So going back to my options here, let's put this trade on. I'm going to submit order and override. You can see I'm going to make after commission about $185 override. So going back to my main window here, you can see I have a short strangle for Stella-Jones. This is a 38.43 short strangle. So right now it's 0 out of 2 quantities filled, which means nobody wants to buy my puts and calls. So if I go up to 90 and update, maybe something will happen. So I'm going to find what the average of these two is. 55 plus 105 divided by 2. So that's 0.8 basically. So if I change this to 0.8, it would be like right in the middle. Okay, so it's been about 25 minutes, 35 minutes, and my short strangle still hasn't been filled. The price is still between minus 0.55 and minus 105, so price hasn't really changed. I'm going to drop this down to 70, minus 0.7 update.
Order filled.
Okay, and then it filled that one. So what this means is this profit loss graph over here. The x-axis, this gray arrow, is the price of the underlying, or the Stella-Jones stock price at the time of expiration, which is in February. And then the y-axis is how much profit or loss I'm going to make. Anything above this line is 0. So the most I can make is, well, that filled at 70 cents. So my short strangle, if I go to trades here, it'll show a price of minus 0.7. two quantities, so 200 shares, that's $140 minus $5 for commission, so 135, meaning the most I can make here is $135. This is basically this level here, and then this is 0, and then this is like minus down there. So if the stock ends between $38 and this is like $43 here, then I make the maximum amount, which is the premium. So I make this today, and anything that I lose is just subtracting from this premium that I earned. So I already have the $135 that's in my brokerage account that's already paid to me. And if the stock maintains its range between 138 and 43, then that's the maximum. If the stock price goes below 38, then I start to lose my $135 until around $37, and then I basically start losing money, which means it's a negative trade for me. The buffer comes from my two premiums, one from the put option, one from the call options, and they're added together to give me this extra high buffer. If I only sold a put option, then this would be lower. And if I only sold a call option, then this would be lower, maybe like $100 for just the put. And then the call option would probably be like $10 or $20. But because I did two at the same time, they got combined, which gives me a larger margin of safety. So to calculate what my break-even point is, if the stock goes below, $38, it's going to be around maybe like 37 point something. So my break-even would be the premium I earned, 135 divided by 200 shares. That gives me this. And if I subtract $38 from that, that's 37.32. So if it falls below, if the stock price falls below 37.32, then this would be a negative trade. Unless, of course, I roll it forward, and I've talked about how to do that before. So on the other hand, if the stock goes above $43, I'm going to start losing money until about almost $44. So again, to calculate that, 135 divided by 200 shares, I'm going to add my $43 strike price. So 43.67 is the break-even point if the stock goes, above my strike price for the call option. So ideally, this would be a profitable trade if it's between 37.3 and 43.67, somewhere within that range. If the stock goes to 44, 45, I have to sell the stock, even though I sell it at technically 43.67. That's still a pretty decent profit, because I bought the shares at $40 this month. That's a 9% profit in 2 months' time, so that's not bad. But if it finishes at $45, then I would have missed out on the difference between 45 and 43.67 times 200 shares, right? So if it finishes at let's say $50, which is very unlikely, but so times 200, then it would have been better if I just held the stock and sold it at $50, and I would make $1,200 more than selling the call option. So when the stock finishes on the upside, it's unlimited loss technically, because it can go to infinity. But because I don't think that's going to happen, I'm okay taking that risk. And it's the same thing for the put option on the downside. But again, I don't think it's going to fall much below $37. 36 maybe, but if it goes to that point, then I'll probably do another short strangle and I'll buy the stock at $34 or $33. So the short strangle is really good if you don't think the stock is going to move too much in either direction. So you can set a lower limit with the put option and a higher limit with the call option, and you just follow the stock. So if it goes down and you get assigned the shares, you can do another short strangle. If it goes up and your shares get called away, you can do another short strangle, assuming you still have enough shares to cover your call option. And it's just a great strategy to make consistent options income, especially on stocks that you don't think will move up or down a lot. The outcomes are you buy the stock at a discount from today, or nothing happens and you just keep the premium, or you sell the stock higher than today's market price, so it's hard to go wrong here, as long as you do it on a high quality company to begin with. You can also sell the put option and call option separately. You'll get the same outcome. The thing with doing them together with the short strangle is you're guaranteed to have both your options filled at the same time. If you need a refresher on what to look for when you're selling put options, click here, or if you want to review how to sell a call option, click here. Thanks a lot for watching. I hope you got something new out of this video. Happy investing, and until next time.